We're going live.
Oh, I got it.
No. Oh, got it, okay.
Got it, literally.
You got the button, all right.
Rush trained.
So we are here. I don't know what my Zoom thing is doing. And I got it, all right, so we're going. Committee. This is a highly adjusted agenda compared to the one we posted on Friday. The reason is I was told at copy room, thank you.
Oh, sorry for the mix up.
No problem. I'm not even sure what this is, so. Anyway, we were told that even though H 196, H 159 is an H bill, that it has to be out of here today. So
Which one?
the
This is the economic
the
development.
big economic development workforce bill. We had it scheduled for 3 days this week, so what I've said I will do, our area of expertise is actually the TIF section. That we'll pull the TIF section, that'll give us time to look at that. And there's still some things left over from the city of Montpelier they want looked at. We have the auditor scheduled later in the week. And then we can put those on miscellaneous tax, which is 738, which is where we're today. And we'll see where that goes. I also spent an hour with Graham and Senator Kitchell going over how much revenue we need to raise, which depends on how much revenue we spend. The bottom line is that the House sent us over a budget that was, I think, $29 million underfunded. They did not account for the cost of the child tax credit. So was the biggest reason. There's all kinds of other moving parts, plus other moving parts that are moving through the Senate. So we're gonna keep working our way through. And I'll have, there's several variations we can do to the child credit, which might lower some of the costs, and then ways, any increase in mutual fund fees has not been accounted for on either side. So that's about 6 million. So we will see where it goes. But we're going to start out with H 738, which is technical and administrative to Vermont tax laws. And Abby is here to walk us through. And for those of you who haven't been in this committee very often, at one point on our wall was the motto, "Seize the Christmas tree." If you remember the Dead Poets Society, which then somebody translated into Latin, which then one of the witnesses told us was the incorrect conjunction or something in the Latin. And eventually it disappeared. But this is miscellaneous tax has generally been our favorite Christmas tree, where it is so broad that any tax thing that we have that doesn't fit anywhere else, it gets attached here. So Abby, why don't you walk us through what we've got, and we'll see where we're gonna go with it.
Great, thank you, Madam Chair. For the record, Abby Shepherd, Office of Legislative Counsel. You'll see several documents under my name today. I'm going to be using primarily the section by section for H 738. And I may call it the miscellaneous tax bill, but as you mentioned, Madam Chair, it is titled An Act Relating to Technical and Administrative Changes to Vermont's Tax Laws. The first three sections relate to the property transfer tax, which applies to any transfer by deed of title to property located in the state or controlling interests. This changes several different titles of statute. So it does change in Title 27, the definition for enhanced life estates. Those, to make it clear that enhanced life estates are taxed in the same way as conventional life estate deeds. And then there are two sections that amend the corresponding provisions in the property transfer tax. And that's in Title 32. So to give a really brief overview of what a life estate deed is, a conventional life estate deed is created when an individual retains an interest in a property that is typically a residence that the individual is able to continue to live in until their death. They pass on interest to the grantee or the beneficiary, and under a conventional life estate, that property will pass automatically upon the grantor's death. However, the grantor still remains responsible and has certain rights and responsibilities. They're responsible for property taxes, and the grantee, the beneficiary, also has certain rights and responsibilities. So, for example, if the grantor, the person still living in the home, decides, in fact, they want to revoke the life estate deed and sell the property, they have to get the beneficiary's consent. So that is a sort of a very general overview of conventional life estate deeds. In 2020, the General Assembly passed these enhanced life estate deeds and created a more beneficial type of life estate deed for the grantor. So they retain far more rights. They can unilaterally revoke or revise a life estate deed, which means that they could, the grantor could decide to sell the property, for example, without obtaining permission or consent from the beneficiary. When that law was passed in 2020, there was no language added in about how the property transfer tax applies to these new life estate deeds. What this language in the in H738 does is makes it clear that enhanced life estate deeds are treated identically to conventional life estate deeds. So that's the first two sections, is saying this is the property transfer tax applies to enhanced life estate deeds. They are referred to in statute as ELEs. I think that's in some of my section by section as well. There is also new language added into the property transfer tax that defines the value of both conventional and enhanced life estate deeds. And that is taken from different IRS regulations. So that is slightly new, but that is more of a clarification than anything else. And then in the section 3, it does create a new different treatment for enhanced life estate deeds and how an individual may request a refund. Because enhanced life estate deeds can be unilaterally revoked or revised by the grantor, there is a greater likelihood that there will be revisions or revocations of those deeds. So under current law, a conventional life estate deed, if there is a revocation, then the taxpayer, which is the beneficiary, can request a refund of property transfer tax paid within 3 years. The new proposed language would allow enhanced life estate deed beneficiaries to request a refund within 8 years after the date that the tax was paid and within 1 year after the revocation or revision occurred. If if 8 years or more has passed after the payment of the tax, then no refund is allowed. And again, if a revision does occur, then the revised transfer. So if perhaps another beneficiary has been added, or if a different new beneficiary is added to the deed, then that will again be taxed. So I will pause there because that's a lot of information. I hope that wasn't too confusing.
Okay, so I think we need to have the tax commissioner come in and talk on this one. Because I don't know that this committee did anything on enhanced like tenancy bills. Senator Pearson, do you have a question?
Yeah, Abby, are you saying, so the last thing you said was that if a name is added to the, I think of it as a trust, what's the right term?
It's a life estate deed.
Then that's considered a transfer. But is that true if like what happens if somebody has a new grandkid and so it's altered, but the property is still effectively in the initial owner's possession? Is that considered a transfer? Because I don't know,
So if there is a new beneficiary and they are receiving value from the transfer, that applies at the time of creating the deed. So if
but that's what I'm wondering is if the transfer doesn't happen yet, but because it sounds like the deed is, well, that's maybe this is why maybe I should be quiet and just try to understand better.
no, that's a great question. So you're asking really when the tax applies, whether it's at the time the property actually transfers to the beneficiary or at the time of the deed is written. It's at the time when the deed is created. So and I would also want to just distinguish between if it were passing to a beneficiary and they passed away and they had heirs who would instead inherit, there wouldn't be any revision to the original deed. That would just be the succession of who would actually inherit or benefit from that deed.
Abby?
Yes.
I know what a life estate is in real estate, but can you just walk us through what is a life estate? What is an enhanced life estate? Can you do that today, or should we? I think that would help us all be starting from the same understanding.
Certainly. I may actually recommend, and I can reach out to my colleague, Eric Fitzpatrick. He does work in that area, and he did draft the enhanced life estate deed.
Okay.
He would probably, but I'm more looking at it from the tax perspective.
And this is just dealing with the tax provisions, but we'll see if he can come in and do life estate 101 for us. Okay.
Yes, I would happily defer to him.
Okay, good. 1 year, half the committee of this committee, everybody was new to finance except Senator McDonald, and half the committee was new to the Senate. We spent several weeks doing 101s. Just
Senator Galbraith's arrival.
might have been, but there were just a lot of just basic information that
Been 1,000.
you need to build on. Okay. So we can keep going then. I think we'll better understand it once we do the base. All right.
Okay. I think just the one major takeaway from those sections that I would like to emphasize is that it does address what is currently silent in statute, because statute only for the property transfer tax purpose only contemplates conventional life estate deeds. So absent action, there isn't clear statutory authority or guidance about how to treat enhanced life estates because they are so new.
Okay. All right, so this is putting the relevant tax positions in that
That's right.
judiciary left silent. All right. Okay. So that gets us on to corporate estimated payments.
Yes. So two more other very technical, and I'll try not to get too into the weeds on these changes. There are two sections that clear up some, again, silence in the statute and inconsistency between multiple sections that relate to the corporate estimated payment filing deadlines and return filing. So filing both for returns and payment, and when underpayment penalties accrue. There were some changes in the last about 5 years to when estimated payment underpayment penalties apply. And because of the change to linking up when corporations are required to file to the federal due dates, the underpayment penalty dates were not also fixed. So this lines everything up to be the same deadline as when corporate payments and returns are due federally. It also makes it clear that within the section that allows for both interest and penalties to apply, that it applies to corporate estimated payments. Because currently, although the section heading or title does state its penalties and interest, only interest is discussed in that section. I'll pause there just to also make it clear that it is the same treatment for corporate estimated payments as it is for individual estimated tax payments.
Okay. We'll go into that a little deeper too.
The next two sections are the annual link up, which I think you all remember from last year last session was quite a significant issue with the different federal laws and legislation that passed and applied retroactively. So the annual link up, it's typically done annually in Vermont to conform to federal statutes that are in effect at a certain date. Currently, they are Vermont's income tax statutes for taxable year 2020 and going forward is linked up through March 31st of 2021. This language would link up through December 31st of 2021. So the full taxable year, any changes that were made to federal statute. And then it would apply that sort of snapshot in time of federal statute to taxable years 2021 and going forward. So it is, Vermont is sort of technically a static conformity state because it does have a specific date when federal statute is in effect. But because it's typically done each year, it becomes sort of a more rolling conformity. So section 6 is for federal income tax statutes and section 7 is for estate tax. I'll pause there for
Estate
questions.
tax is new.
That's typically included.
Is
that's-
it? Okay.
Yes, for both. It's just that it doesn't get as much discussion because there are very few, if any, changes made federally to the estate tax, whereas federal income tax has been changing significantly every year for the last few years.
Okay, Senator Hardy, you're the.
Yeah, I was just wondering, I don't see it on our webs page, so is there a fiscal note that goes with this? I remember last year with the federal link up there, what were fiscal implications? Are there this year?
Hey, Graham's gonna be testifying next on the.
Oh, okay. I
Okay,
can wait for you, Graham. Thank you.
okay. So. Senator Pierce.
Sorry, Madam Chair. Abby, why the change and not the March 31st standard?
That pulls in the full year, the full calendar year, taxable year of any changes. But as I'm sure Graham will discuss shortly, there haven't been any really significant changes in that time between March and December 31st.
We'll have the tax commissioner explain. Okay. We could keep going.
The next 4 changes were, so I actually didn't mention that most of these were requests. This is the typical committee bill that's introduced by the Ways and Means Committee. This is, a lot of these are requests from the administration. The next 4 sections were, my understanding, a joint treasurer's office and administration proposal to clarify some movement of funds and the administration of the Vermont Children's Trust Fund. It's one of the checkoff boxes on the personal income tax return. So an individual can donate their income tax refund to different programs. One of them is the Children's Trust Fund. Currently, it is administered in the Agency of Human Services and with the Children and Family Council for Prevention Programs. The request that is enacted here, the changes would be to move the administration of those checkoff funds from AHS to the Vermont Children's Trust Foundation, which is currently the primary recipient of these funds anyway, to sort of remove an administrative hurdle there. It makes a few changes to statute and repeals several sections and cross references, but there is a fair amount of language that you'll see in the bill itself that is moving current requirements for the funding and grant process from AHS to the Vermont Children's Trust Foundation. There's also some transition language that applies to the Children's Trust Fund, which is repealed under the bill. So first, it requires all funds that are in the Children's Trust Fund to be swept out and transferred to the Children's Trust Foundation on July 1st and on December 30th of this year. And then on December 31st, the fund itself is repealed.
Okay. Questions on that one? We'll ask the treasurer to come in and tell us why. Senator Hardy.
Is the Children's Trust Foundation a private entity or is it a state entity?
Yes, thank you for mentioning that. That is not a state entity,
Huh, okay.
But
which is
it
somewhat unusual.
It is, all right, so we are creating this foundation.
No, the foundation is already in existence, but it would transfer the funds from the checkoff that the Department of Taxes collects. Because they're refunds, the department already has the taxes paid. It directs the department to transfer that directly to the foundation instead of putting it into the special fund.
And AHS, how does the Children's Trust Fund become involved now, do you know?
So the checkoff funds are deposited into the trust fund. That would be repealed. Instead, the monies would go directly to the Children's Trust Foundation. So it eliminates one special fund.
Okay, we'll have the treasurer. Tell us why. All right. Other questions? Okay, we'll keep going.
Okay, the next two sections are actually sort of the bulk of the page length in this bill. The first section, section 12, requires a taxpayer to amend an income tax return and pay any tax owed if there is a change in federal tax liability resulting from the audit of a partnership or an adjustment of a partnership's taxable income. So this is requiring reporting that is required at the federal level, and Vermont does not currently have the authority to require for the state. And so it creates a new entity level partnership reporting structure. This partnership reporting and audit sort of pushing out tax liability to a partnership at the entity level instead of the individual partners or members was first authorized federally in 2015, and states have slowly been adding similar sort of mirroring reporting requirements in state statute. And again, it's a lot of language, a lot of it is definitions, and then going through all of the different circumstances where partnerships may owe tax and the different structures. These are often very complex entities, and how their tax is calculated. So I've tried to summarize it in section 13. That is where this new section is being created that authorizes Vermont to require reporting. The partnership will elect to either pay the tax, pay the adjusted tax amount itself, or the individual partners will pay. And if an individual partner pays, then regardless of the taxpayer status, because you can have corporate members, for example, corporate partners of a partnership, the tax will apply at the highest marginal tax rate. Each election is irrevocable. It does allow for one individual to be the state partnership representative in case that makes more sense for the partnership rather than having their federal representative. These are just a few of the details that are in the language. So I will pause there because it's lengthy and some of it is complex, but the underlying purpose behind it is to allow Vermont to have more information about federal audits of partnerships.
Okay,
So, Madam Chair,
yes,
this is a historic moment. we have talked about partnerships, which are partnerships.
Yeah,
Is that how they're defined?
okay. I think you, unless there is a question, I think we can go on. So we are on
Section 14.
section 14, okay.
So section 14 will also give some of you flashbacks to last year when you worked on the miscellaneous energy bill, and went into quite a bit of detail. There's quite a bit of complexity as to how energy plants, renewable energy plants, and in particular, the treatment of energy storage facilities between both the uniform capacity tax, which applies to larger renewable energy plants, and the property tax. And it turns out in the draft, in the language that was enacted, there was a very narrow cross-reference that only referenced the education property tax, whereas there are multiple chapters that deal with the property tax system, both municipal and the state education property tax. So this proposal is to expand the reference so that the entire property tax system is captured. And I'll pause there because the language itself sounds a little confusing because it's addressing what is not the change to energy storage facilities and how they're taxed on the uniform capacity tax. The language says that does not affect any property tax liability for that property. And I'll pause there before I confuse you all.
Okay, Senator Hardy, you had a.
I was just gonna ask you what page you were on, because the first section, the previous section was so long, I was scrolling.
Yes.
Trying to find it, but you're on page
Let me-
28, is that right?
It is page 29 is section 14. And so the language in statute, it's title 32, section 8701. It's sort of a cross-reference saying the uniform capacity tax and whether it applies or does not apply to a certain property does not alter the taxation of underlying property under the property tax. However, the reference in here was too narrow and it was only to the education property tax. It should have applied to the entire property tax system. If this change were not enacted, then there would be two different valuation approaches, one for municipal and one for the state education tax. And because in another part of the miscellaneous energy bill last year, there was a different valuation scheme created for underlying land.
Okay, I remember doing that, but what we did is we said school and we should have said
All property, because
okay,
property is valued by municipalities and those are the same values that are used for the state grand list. So logically this would follow. It's not sure that there are any circumstances, or there are very few circumstances where property is valued differently for municipal versus state property taxes.
okay. I think that's clear. Okay, so now we're going on to hunting, fishing, hunting, and trapping licenses. This is a miscellaneous bill. That's
The
right.
next two
Okay.
sections relate to state recognized Native American tribes that in, I believe it was just last year, and I can check that, I'm sorry. There was language creating free hunting, fishing, and trapping licenses, but it was interpreted by the administration as not applying to tags. So this expands the existing language to allow any state recognized Native American tribe members to receive any of those licenses. It also requires a report from the Department of Fish and Wildlife in 2024 to House Committees on Natural Resources, Fish and Wildlife, Ways and Means, and the Senate Committees on Natural Resources, Energy, and on Finance on how many of these licenses have been issued and what the cost is.
So
So that concludes for the substantive sections. And then there are, of course, the lengthy effective dates that are in all tax bills.
Okay, we've got a couple questions, Senator Bray and then Senator Hardy.
Ms. Shepherd, can you help me remember last year when we did the Fish and Wildlife, the hunting licensing? not every feature was included, right? So can you remind me, in part that was because it came through at, 11:59 PM and 50 seconds. So it was like the very end of session. And it sounds like they're just expanding on what we already did, right?
That is my understanding, but this is language that was drafted by my colleague Michael O'Grady, so I will have to defer to him on what exactly was done last session, and I can circle back. But my understanding is that this is attempting to make all licenses and tags free for members of those state recognized tribes, and that was the intent last year. But I will either encourage you to hear from him, or I can get that answer for you.
We'll see when we can get him. This bill is not going out anytime really soon. It's usually one of the last to leave, so this is
One of
just,
those things, it was not quote unquote a big deal, but it came up at the very last second. And rather than miss the bus entirely, we proceeded and knew that we might need to come back.
Okay. Senator Hardy, you have a question?
Yeah.
Senator Sorokin?
Thank you, Madam Chair. Abby, on this section 15, it strikes the word free and just says may receive one or all. The intent is that they be free, but receiving something doesn't mean you get it for free. You could pay money and then receive it. So I'm wondering, do we need to re-include the word free?
That's a good point. I will confirm with the drafter if
Great,
that was
thanks.
intentional.
Okay. Other questions? Senator Sorokin?
Thanks, Abby. Just so I'm clear, you still need a license for all these things. It's given for free. It's not like you can go ahead and fish without a license.
That is my understanding.
Okay.
Yes.
It was sort of a restoration of original rights.
Well, my firm represented Homer St. Francis on a fishing case about 25 years ago, and that was the issue, whether it needed a license or not.
So this is, the trade-off here is, rather than contesting that issue, we just issue the licenses.
Okay. All right. Other questions on this? Senator Pearson?
Well, I'm curious if the hunting seasons apply still, and it's just basically the same structure for everybody, but no fee.
We should probably hear from O'Grady. My
Yeah, I think
understanding is,
we'll get O'Grady in.
I think all the same, there's no changing the rules. It was issuing the license tags and permits, because there's, a collection of things you can end up with in order to be able to do every kind of activity allowed.
Yeah, thank you.
Okay. Other questions? We are ahead of time. So if there aren't any questions,
Are we gonna hear from Graham?
we are going to hear from Graham. And we might get a short break in. So Graham, floor is yours.
Thank you, Madam Chair. My name is Graham Campbell from the Joint Fiscal Office. These are some of my favorite bills because it doesn't require a whole lot of work on my end. We estimate that this bill will have negligible fiscal impact on the state. The only place that could have an impact on the state revenues is the Native American fishing and hunting licenses language. There's the potential for that to reduce state revenues by up to between $5,000 and $8,000 a year, but it's somewhat uncertain to the degree of which it'll be taken up. So we didn't even feel comfortable putting it into or booking it as a revenue loss. So end of the day, there is no fiscal note for this bill. because there's negligible fiscal impact. To speak to Senator Hardy's question about the link up language, I think Abby touched upon it. The reason why there's no impact on the state is because there have been very limited federal tax changes between the previous link up in March of 2021 and the link up language being proposed here. There are sort of inflation adjustments that happen every single year, but those are not, we don't typically estimate the impact of those changes and provisions. So for instance, the earned income tax credit income threshold brackets are changed every single year. And because we're tied to those thresholds, we pick them up when they're changed because of inflation, but we don't usually estimate what those, what type of revenue change that would have on the state. So yeah, I guess to close that, we don't anticipate any of these provisions having significant fiscal impact. And the only one that we've sort of identified is the Native American fishing and hunting license change here.
Graham, the reason December 31st is when we usually did the link up, right? And it got moved to March because the federal government made changes into March. Unemployment insurance taxability, I think, is one. So we moved it to March. Now we're just going back to where it would normally be, which is the beginning of the calendar year. Okay. Senator Siraki, you have a question.
Yeah, we had a long debate last year, Graham, or the year before, on the state taxability of PPP. Have there been no federal programs that we have to link up with since to make sure that they're either taxable or not taxable at the state level?
Not that I'm aware of that are of significant size, but I'll of course double check that. But it would basically have to be a new program or a new program created between March of 2021 and December 31st of 2021 that issued new money to recipients, like a completely new program. Either that or an existing program where the taxability was changed. And I'm not aware of any new program that was created in that period.
One I'm thinking of is the rental program, where there are hundreds of millions of dollars passing through the state to pay people's rent. And I don't know whether that might be something that is income to the landlord or income to the tenant.
I'll look into that and confirm whether there was any language there with respect to the tax bill or how that might be treated. I'm not aware of the program that you're speaking about. So I'll look into that and get back to you.
Okay, other questions for Graham? All right, so committee, we are about 15 minutes ahead. So unless Faith tells me otherwise, I'm going to take us off live stream. We've got about a 15-minute break. All right.
Ending live stream now.
Thank you.